Alain, I want to start with you. Should I just take the rest of the month off and come back on June 30th and have a look at what the can kicking looks like? Is that an option?
I don't think so. We have seen so many weeks of negotiations, which are very hard negotiations. I would say a bit macho from one and the other side of the negotiation, from Greece and people from Merkel, Holland, and the IMF. So what I read is that we are very close to the final deal. It's the two outcomes, win-win for everybody or lose-lose for everybody. And I think after all the improvements in the governance of the Eurozone we have been seeing in the last few quarters, I can't imagine that they won't strike a deal by next week.
Manish, close to a deal? All signs say we are nowhere near a deal right now.
Yeah, I think it is all leading to a crescendo, isn't it, at this time? My view has always been that, Greece will get a deal because Germany wants the deal to happen. And Germany doesn't see a Brexit. So to me, but to me, the most important thing is ECB and ECB's role. So the whole contagion, I believe, will be contained given that ECB is a lender of last resort. So I'm less worried about that.
Alain, I was reading your latest report this week. Go to cash. That was one of the takeaways for me. Increase your allocation to cash. Why? Why now?
There are two reasons. One, we are heading from the fear of deflation into the fear of inflation. Remember, the inflation and the oil price went from 40 to 60 plus in dollars per barrel. So we know that in the forthcoming 2 quarters, the headline consumer price indices are going to go up, and this will force investors to revisit that fears of deflation are out of the system, and we are heading for fears of inflation, meaning the Fed and Mrs. Yellen are going to announce by H2, by the end of this year, that they must exit the super loose monetary policy in the US. That is obviously a risk-off scenario. On top of which, you have what we call the correlation between equities and bond prices, which are changed from negative to positive. In the recent past, when bond prices were going down, when yields were going up, equity prices were going down. This is a new market pattern where you can't hedge having a multi-asset portfolio with equities and bonds. When the bond market suffers, then the equity market suffers also. So the only safe haven at the moment is either cash or US Treasuries.
Manish, when you manage other people's money, it's hard to tell them that you're just going to leave it in cash and then charge them for the privilege. Is that an option right now for you?
Well, you have to be tactical. I would say that, we are looking at some trades. So I still believe that, the Eurozone economy is doing well. And like I said, for me, the main thing, what has changed since 2012 is that ECB doing its QE, acting as lender of last resort, prevents contagion. So you have to pick your trades. And then look at what Fed is going to do next week. I mean, will we get a surprise rate rise? That is something which nobody is talking about. And I will not rule that out to zero, though I still think it will be only in September that you say a rate rise.
Alain, as you look at the situation with the Fed and we look ahead to next week over in DC, the Federal Reserve meets, how are you expecting to play this out in the next couple of months? Do you think the Fed needs to get ahead of the curve if, for that matter, your theory does play out and inflation overshoots to the upside? How does the Fed handle that?
The Fed, we know, must be and has always been proactive, trying to be ahead of events, not to be accused of being behind the curve for too long. But what we should also add on the Fed's monetary policy analysis is that they have many tools at hand. The market is focusing quasi-exclusively on the rate setting, so the rate hike from 0 rate to something plus. But the Fed can also play with the dots. That means the forward guidance on the path for the interest rate in the next 2 to 3 years. The Fed can also play with the total size of the balance sheet, which has increased from 800 million to 4,500 billion in the last few years. So they're going to decrease that somewhat. So the Fed has many, many, many tools they can play with. It is not be exclusively on the rates policy.
John, that's correct. And because I think controlling inflation will be a main thing. Because remember, one thing Fed has said that they can pay higher amount on deposit to keep the money. Now, that is not going to be politically acceptable. Because if you have European banks getting money from US taxpayer, and remember, Fed was given this power by the Congress in 2008 to pay money on deposits. So that is a very controversial one, whether Fed can use that measure to control inflation or not. So inflationary fears going ahead is real, and that is something that we will have to hear from Fed what they want to do about it.
Alain, this is a movie I've seen before. The big difference is that 3 months ago, everybody's there fearing deflation, and now we sit here and you guys are all talking about inflation overshooting to the upside. Alain, when I look at your strategy with your portfolio, reduce your holdings of bonds, well, bonds are heading for their worst quarter on record if you look at Bank of America Merrill Lynch indexes. How do you play it? Why not even be more aggressive, really pull back your allocation to bonds?
One needs to be careful about the wording one uses. Fixed income, where you have a fixed coupon on a bond, is somewhat in danger at a time when the inflation regime switches from the fear of deflation, negative inflation, to somewhat positive. We're not looking at hyperinflation miles away. But fixed income with fixed coupon is not a good idea in this environment, and it is rather expensive, except maybe on US Treasuries. However, you have many viable coupons, what we call inflation-linked bonds. They can be big in the US. You have a big market in the UK, in Italy or France, for what is considered in the West. And so I would advise to switch out of fixed income into more viable income within the bond portfolio.
Manish, just to wrap things up, the takeaway from the conversation I've just had with both of you, I look at the VIX, why not just buy volatility in the US right now? Compared to what's happening in Europe, it's been pretty unmoved throughout the last couple of months.
Well, I mean, I'm not a VIX trader, I would rather trade equities, and my view is that, I really feel positive about equities, because you don't see a recession happening, unless you really see that valuation is high, or Fed is going to take the punch bowl away, or you have some global macro crisis. So if you look at valuations, then, it's fair enough at this moment. So I think there's still room for equities to play.
Alain Bokobza, Head of Global Asset Allocation at Societe Generale, thank you very much for joining us this morning. A real privilege, a pleasure. Manish Singh,